If markets are efficient, the difference between the intrinsic value and market value of a company's security is, and here we're saying that it's basically telling you, take this as given, markets are efficient. What is the expected difference between the intrinsic and the market value of a company's shares? Negative, zero, or positive? It would be zero. The intrinsic value of an undervalued asset is less than the asset's market value, greater than the asset's market value, or the value at which the asset can currently be bought or sold. Well, we're looking for intrinsic value. The value at which an asset can currently be bought or sold is a market value. We can eliminate that. If we're saying that it is undervalued, that means what we're saying is that when we look at the market value versus the intrinsic value is higher than the market value. Hence, we would buy it because we say it's worth this, but the market says it's only worth that. Let's buy it. So the intrinsic value is greater than the asset's market value. 7 is B. The market value of an undervalued asset is greater than the asset's intrinsic value. Well, we just showed an undervalued asset here, and the market value is less than the asset's intrinsic value. You can get rid of that. Is the value at which the asset can currently be bought or sold, or equal to the present value of all the asset's expected cash flows? Well, that's the definition of intrinsic value, right? So we can get rid of that. The market value of an undervalued asset. In fact, you don't even have to say undervalued asset. All you have to do is end here. The market value of an asset is the value at which an asset can currently be bought or sold. Undervalued, fairly valued, or overvalued. That's what market value is, period. You have to select B. In an efficient market, the change in a company's share price is most likely the result of insiders' private information, the previous day's change in stock price, or new information coming into the market. And it's saying, basically, in an efficient market, so we have to take the efficient market as given. What would change the price? Only new information. None of these other things. Only new information. So C. Regulation that restricts some investors from participating in a market will most likely impede market efficiency, have no effect on market efficiency, or contribute to market efficiency. So you're restricting some investors. Remember, that's an impediment, right? So that would impede market efficiency. With respect to efficient market theory, when a market allows short selling, the efficiency of the market is most likely to increase, decrease, or remain the same. It allows short selling, so more people can act on information. You would get an increase in efficiency. Which of the following regulations will most likely contribute to market efficiency? Regulatory restrictions on short selling, on foreign traders, or on insiders trading with non-public information? Well, restriction on short selling is an impediment to efficiency. A restriction on particular people trading or particular investors trading is an impediment. But this helps make the market a little bit more trustworthy, a little bit more confidence in it. That would actually improve efficiency. Which of the following market regulations will most likely impede? We're looking for impede market efficiency. Restricting traders' ability to short sell? Yeah. Allowing unrestricted foreign investor trading? Well, that's a regulation that allows it to happen, so no, that would probably improve efficiency, so we can eliminate that. Penalizing investors who trade with non-public information? No, that's a good thing. So that would impede market efficiency, any restriction in that sense. An increase in the time between when an order to trade a security is placed and when the order is executed most likely indicates that market efficiency has decreased, remained the same, or increased. Well, timely transactions, right? That's one of the hallmarks of an efficient market. And if the time is increasing, efficiency must be decreasing. With respect to the efficient market hypotheses, if security prices reflect only past prices and trading volume information, then the market is weak form, strong form, or semi-strong form. So the security prices are reflecting only past prices and trading volume. That is weak form efficient. Semi-strong means it also reflects public information. Strong form is reflecting private information. Which of the following statements best describes the semi-strong form of market efficiency? Empirical tests examine the historical patterns in security markets. security prices reflect all publicly known and available information. Semi-strong form efficient markets are not necessarily weak form efficient. Well, we can eliminate the third one because we have a hierarchy of weak, semi-strong, and finally strong. That's an O, strong. To be semi-strong, it must already be weak. It's already assumed. To be strong, it must be semi-strong. You cannot be strong, but also weak, inefficient, and semi-strong, inefficient. It's a hierarchy, right? So we can eliminate that. So for number 10, semi-strong is exactly this statement. Security prices reflect all publicly known and available information. 10 is B. If prices reflect all public and private information, the market is best described as weak form efficient, strong form efficient, or semi-strong form efficient. Well, if it's reflecting all public and private information, we got to go with strong form efficient. If markets are semi-strong efficient, standard fundamental analysis will yield abnormal trading profits that are negative, equal to zero, and positive. So there's two things in here you have to know. You have to understand semi-strong efficient and the relationship with standard fundamental analysis. That efficiency here says that can't help you earn abnormal profits. And you have to have some idea of what abnormal profits are. These are profits in excess of a return suitable for the risk that you've taken on. So abnormal trading profits would be equal to zero. If markets are semi-strong form efficient, then passive portfolio management strategies are most likely to earn abnormal returns. Well, anytime we make the assumption of any kind of efficiency, you can get rid of abnormal returns. So that's gone. Outperform active trading strategies or underperform active trading strategies. Well, when we say it's efficient, there is no return to active management, which means all you're going to pay for is the in the long run is the market return with a whole bunch of fees. So you'll actually underperform the passive. So passive portfolio strategies are more likely to outperform active trading strategies after fees. If a market is semi-strong form efficient, the risk-adjusted returns of a passively managed portfolio relative to an actively managed portfolio are most likely lower, higher, or the same. The risk-adjusted returns are most likely higher, lower, or the same. Well, lower, higher, or the same. Well, we could follow off the question we had previously. You have to take your fees off to get your return, so your risk-adjusted return on a passive portfolio will be higher. Technical analysts assume that markets are weak form efficient, weak form inefficient, or strong form efficient. Well, technical analysts assume markets are inefficient. They don't believe they don't buy into the efficient market hypothesis. So anything efficient you can get rid of. They believe it is weak form inefficient. Fundamental analysts assume that markets are any efficiency assumes away technical and fundamental analysis. So if you're going to engage in fundamental analysis, you must buy into the fact that there must be some inefficiency. So fundamental analysts assume that markets are weak form inefficient, semi-strong form efficient, or semi-strong form inefficient. Fundamental analysis deals with publicly available information. So you'd be at least the semi-strong level. Would you be efficient or inefficient at this point? If you're engaging in fundamental analysis, you'd assume some level of efficiency, right? 16 is C. If a market is weak form efficient, but semi-strong form inefficient, then which of the following types of portfolio management is most likely to produce abnormal returns? Passive portfolio management, active portfolio management based on technical analysis, or active portfolio management based on fundamental analysis? Well, we're saying it's weak form efficient, but semi-strong form inefficient. So this will take technical analysis out of the game, so we can eliminate this one. We have some form of inefficiency here, so we should expect active to outperform passive, so we can get rid of passive. Active portfolio management based on fundamental analysis. That's at the level of semi-strong. But here we have inefficiency. Which of the following is least likely to explain the January effect anomaly? Least likely. tax loss selling, release of new information in January, or window dressing of portfolio holdings. We're looking for a reason why. On this one, it would be the release of new information in January. Information is released all the time. All the time. It's not just January that has special information. It's released all the time. But this is a particular reason to explain January. This is a particular reason to explain January. But new information explains, well, it happens all the time. If a researcher conducting empirical tests of a trading strategy using time series of returns finds statistically significant abnormal returns, then the researcher has most likely found a market anomaly, evidence of market inefficiency, or a strategy to produce future abnormal returns. And I said in the review, if you find one of these calendar anomalies or one of these other anomalies, all you found is an anomaly. There's really nothing there. So what has he most likely found? A market anomaly. Researchers have found that value stocks have consistently outperformed growth stocks. An investor wishing to exploit the value effect should purchase the stock of companies with above average, so we're looking for a marker, something one of these three that identified as a value stock, above average dividend yield, market to book ratio, or price to earnings ratio. Well, if we have a PE and it's above average, it means the price is way above the earnings. That would be overvalued. That would be growth, not value. You can get rid of that. Market to book, so we have the market value to book value. The higher it is, the greater the market value is with respect to the book value. That tells me that tends to be overvalued. Dividend yields, yes, because the stock price is too low. Remember, the dividend yield is the dividend over the price of the stock. So the lower the denominator, the higher the dividend yield. So low price stocks, undervalued stocks, would have high dividend yields. Which of the following market anomalies is inconsistent with weak form market efficiency? Inconsistent. Earnings surprise, momentum pattern, closed-end fund discount, which is inconsistent with weak form efficiency. Remember now, weak form efficiency says there's no information in past prices, so technical analysis is useless. Well, patterns must be useless then, right? So B is inconsistent with weak form market efficiency. With respect to efficient markets, a company whose share price reacts gradually to the public release of its annual report most likely indicates that the market where the company trades is semi-strong form efficient, subject to behavioral biases, or receiving additional information about the company. So whenever we get to these questions, because you look at subject to behavioral biases, you say, well, that kind of sounds like it, right? What you need to do is you need to take the question at its word. With respect to efficient markets, in other words, it is basically telling you markets are efficient. If we see something like this going on, consistent with an efficient market, what would it be? Well, behavioral biases don't exist in efficient markets. So what do we got? A company whose share price reacts gradually to the public release of its annual report most likely indicates that the market is still receiving additional information about the company. You have to answer it consistent with the assumption it's giving you. Be careful about that, because you might look at this subject to behavioral bias and say, aha, I remember that, that's it. You must answer consistently. C. 24. With respect to rational and irrational investment decisions, the efficient market hypothesis requires only that the market is rational, that all investors make rational decisions, that some investors make irrational decisions. This one I don't like because, and I'll tell you as soon as we answer it why I don't like it. But how can we answer this in a decent way? What we can do is we can eliminate stuff. It's saying here, the efficient market hypothesis requires that some investors make irrational decisions. Well, it would never require that some investors make irrational decisions. We can get rid of that. It requires that all investors make rational decisions, or only that the market is rational. When you look at these two, you go, I don't really know. All investors, that's an extreme word. I'd give that up and I would take this. And that is the right answer. Let me tell you why I don't like it. It's like saying organizations act, organizations think, markets are rational. First of all, markets are nothing. Humans are rational. The market is just the sum total of all human behavior. So to say that a market is rational is to attribute a characteristic to a market that it simply cannot have. It's like saying organizations behave a certain way. Well, organizations don't behave, people behave. So it's just bad English. It's just bad writing, and it's just a bad statement, only that the market is rational. A better wording would have for this would have been only that participants are net rational. That would have been better, that participants are net rational. Because efficient hypotheses doesn't say that all investors need to be rational. Some can be irrational. It's just that the majority of them, that represents the majority of the money, is acting rationally. Hence, it doesn't matter if a few are acting irrationally, they're drowned out by the bigger money. I don't like it when we attribute to inert things like markets, organizations, things like that, behavior that's indicative just of human behavior. That is a question I would never ask. 25. Observed overreactions in markets can be explained by an investor's degree of risk aversion, loss aversion, or confidence in the market. This is a terrible question. It has two answers. And I'll explain why it has two answers in a minute. It's just saying observed overreaction. Well, you can have reaction to the upside, that's called a bubble, and you can have reaction to the downside, heavy selling, way below what would be realistic. So all of those answers really matter. Your risk-averse market is dropping. What do you want to do? You want to get out of the way. Confidence in the market? Yeah, confidence in the market, so you keep buying, and up it goes into irrational territory. Loss aversion, you don't want to take your losses, so you keep riding your losers down. You're selling your winners, you're riding your losers. That could cause it too. What they're looking at in this particular case, the answer is loss aversion, but the explanation they give is that investors hate losses, so they jump out of stocks very, very quickly. That when stocks are dropping, they'll jump out very, very fast. Unfortunately, that's not really what loss aversion means. 25 is just a very bad question. What I want you to do is I want you just to cross that out and not pay attention to it. There's nothing to learn here other than these questions are written by humans, and humans are fallible. And this is just a terribly written question. 26. Like traditional finance models, the behavioral theory of loss aversion assumes that investors dislike risk. However, the dislike of risk in behavioral theory is assumed to be leptokurtic, symmetrical, or asymmetrical. This one here, what it's saying here is that investors dislike a loss of a given size more than they like a gain of a certain size. Hence, they're unwilling to take those losses in the hopes that they'll come back, but they're far more willing to take gains when they're there. That's loss aversion. So that the distribution is asymmetrical in that particular sense.